Imagine currencies as products in a global marketplace. Their values go up and down based on supply and demand. When more people want a currency, its value rises. When fewer people want it, the value falls. Many factors influence this supply and demand. Economic health is a big one. If a country's economy is strong, more people want its currency. Political stability matters too. Investors prefer currencies from stable countries. Interest rates play a role as well. Higher rates can attract more buyers for a currency. The US dollar, often called the greenback, is facing a downward trend. It's losing value against other major currencies. This isn't happening overnight. It's a gradual process that's been ongoing for some time. The dollar's strength has been waning since its peak in 2020. In early 2020, €1 was worth about $1.10. Now, it's closer to $1.20. This means the dollar doesn't buy as much as it used to in Europe. The same trend is happening with other currencies too. Understanding these changes is key to navigating the current economic landscape. Several factors are contributing to the dollar's decline. One major issue is the trade deficit. The US is importing more than it's exporting. This creates an excess of dollars in the global market. Inflation is another crucial factor. The US has been experiencing higher inflation rates recently. When prices rise faster than expected, it erodes the dollar's purchasing power. Interest rates play a significant role too. The Federal Reserve has kept rates low to stimulate the economy. A weaker dollar has real-world impacts on everyday life, affecting various aspects of our daily routines. One of the most noticeable effects is on travel, especially international travel. When the dollar is weak, overseas trips become more expensive, making vacations and business trips costlier. Imported goods also become more expensive, impacting your grocery bills and shopping expenses. Many products we use daily come from other countries, from electronics to clothing. As the dollar weakens, it takes more dollars to buy these items, leading to higher overall costs. On the flip side, a weak dollar can be good for some people, particularly those in export businesses. If you work in export-oriented industries, your products become more competitive globally, boosting sales. This could lead to increased sales and potentially more jobs, benefiting the economy. The key is to understand how these changes might affect your personal finances and plan accordingly, making informed decisions to mitigate negative impacts. The weakening of the US dollar has broader implications beyond individual wallets. It affects not just personal savings and investments, but also the broader economic landscape. It can shift the balance of global economic power, altering the dynamics between nations. As the dollar loses value, other currencies might gain prominence, potentially reshaping the global financial hierarchy. This could lead to changes in international trade patterns, affecting how and where goods are exchanged. For the US economy as a whole, a weaker dollar can be a double-edged sword, presenting both opportunities and challenges. It can boost exports and make American products more competitive globally, potentially increasing market share. However, it also means higher costs for imported raw materials, which can impact production costs and consumer prices. The dollar's status as the world's primary reserve currency could be at stake, raising questions about its future role. If the dollar continues to weaken, countries might diversify into other currencies, seeking stability elsewhere. This could have far-reaching effects on global financial systems, influencing everything from international loans to investment strategies. Predicting the future of currency markets is notoriously difficult, often compared to looking into a crystal ball. However, we can look at current trends and expert opinions for insights, which can provide some guidance. Many economists believe the dollar's weakness might persist in the near term, influenced by various economic factors. Factors like ongoing trade imbalances and low interest rates continue to exert pressure on the dollar's value. However, the situation could change quickly, as economic indicators are highly volatile. A shift in Federal Reserve policy, such as raising interest rates, could strengthen the dollar significantly. Economic recovery post-pandemic might also boost its value, as increased economic activity can lead to a stronger currency. For individuals, it's wise to stay informed but not panic, as market fluctuations are normal. Diversifying investments and considering the impact on personal finances is prudent, as it spreads risk. Staying informed and adaptable is the best approach in this ever-changing economic landscape, ensuring you can respond to changes effectively.